Hi everyone, welcome to the second module in the SaaS FP&A series with Nerded Off. Today we are covering churn, NRR and GRR, the metrics that tells you whether your existing customer base is healthy. A company with great NRR can grow even with zero new sales. Let's break it all down and understand what each of these terms are. First of all, we'll understand what is churn. So, churn is the rate at which your customers or revenue leaves your business. So, in simple terms, it is the customer and the revenue because of those customers you are losing from your business. Let's understand this with the example of a gym. Let's suppose there are 50 new members who sign up each month, but 30 cancels as well. So, your net growth is just 20 customers. So, that churn, that loss of 30 customers is nothing but your churn value or your churn number. High churn is not good for any business as it kills the growth. The formula for churn is divided into two portions, logo churn and revenue churn. Logo churn takes into consideration the count of customers we are losing, whereas revenue churn takes into consideration the actual revenue that we are losing. So the formula for logo churn is churned customers divided by starting customers, and for revenue churn, the formula is churned MRR divided by starting MRR. Both are expressed as percentages, and obviously lower the better. Moving on, let's discuss the difference between logo churn and revenue churn. Logo churn counts the number of customers who left, whereas revenue churn counts the dollars that left the business. Revenue churn is always more important. Why? Because in case of logo churn, you're only able to get how many customers you are losing. So, for example, there is a customer in your business who is contributing $1 million into your business. So through that customer, if you calculate the logo churn, your value will only come as one, and you won't be able to see that significant difference of $1 million. That's why calculating revenue churn is also very important so that you get to know what kind of customers are leaving your business, whether those customers have huge revenue base in your business or not. So it is very important to analyze both the churn, whether it is logo or revenue, so that you can get to know what is the main impact on your business. This is one of the most important distinction in SaaS. A company celebrate 1% logo churn while quietly losing 30% of its revenue if a large account churns. Revenue churn is the metric that actually matters for FP&A and investors. Now let's look at the Excel example to understand the same in detail. First of all, let's look at logo churn rate. We have total customers as 200, new customers that we acquired this month is 15, total customers who cancelled is 7. So the customers toward the end of this month would be 200 plus new customers minus the customers who left us, which gives us 208 as the end customers toward the next month. Now, if we have to calculate the logo churn rate, it's very simple. Churn divided by the starting MRR, which comes out to be 3.5%. Now, let's look at revenue churn rate. Here we have starting MRR, which is 100,000, churned MRR 7,000, contraction MRR, which is 3,000. Now, if we have to calculate total MRR lost, it would be 7,000 plus 3,000. So, this is the amount of business or revenue we are losing. Now, let's calculate churn rate, which is churned customers divided by starting MRR, which comes out to be 7%. Now, there is one more formula which is generally asked, which is net revenue churn. The only difference between revenue churn rate and net revenue churn rate is contraction. In net revenue churn rate, we also include contraction. So, it would be simply 10,000 divided by 100,000, which gives us 10%. Next, we have is what is NRR and GRR. These are the two powerful KPIs that every FP&A business track to understand how well a business is retaining or growing the existing customers. First of all, we have NRR, which is net revenue retention. So, the formula for net revenue retention is starting MRR plus expansion, that is if our existing customers are taking better plans or better premium services from us. Contraction is downgrades of the current customer's subscription. And churn is losing the customer, divided by starting MRR. Whereas GRR is gross revenue retention, then the formula for it is starting MRR minus contraction minus churn dividing by starting MRR. The only difference between these two formula is expansion. What is happening here is in NRR, we are trying to understand if the existing customer takes better plan or takes new plans or new services from us, how much new revenue we are getting. But in case of GRR, we are only trying to understand how much revenue we are able to keep in the business without any upsells. So both of the metric are very important in the business, but in FP&A and for investors, they always look at NRR more than GRR. Why? NRR can exceed 100 if the expansion is greater than churn plus contraction. NRR can be greater than 100. This means you're growing a lot from your existing customers. GRR cannot be greater than 100%. Why? Because it ignores upsells. It only works at the minimum flooring. You will be able to understand it better with the help of an Excel example, which we will be sharing soon. Together, they tell a different story. NRR show growth potential, how much my business can grow with the existing customers, because I'm taking into consideration both upsells, downgrades, with that churn as well. But in case of GRR, we are only taking into consideration downgrades, downsells, and churn. So, where NRR shows the growth potential, GRR shows the baseline retention strength. So, both are important for the investor diligence. Now, let's look at the NRR and GRR calculation. So, first of all, we have the input data, which is starting MRR is 100,000. New MRR in the business that we got is 8,000, expansion MRR is 15,000, contraction MRR is 3,000, and churn MRR here is 7,000. So, first of all, we have to calculate ending MRR. So, the formula is mentioned here, which is start plus new plus expansion minus contraction minus churn. So, simply we will be taking all variables into consideration and we will subtract 3,000 and 7,000, which gives us 113,000 as our ending MRR. Now we have to calculate MRR growth, which is ending MRR minus starting MRR. So the growth in dollar terms is 13,000. And if we have to calculate MRR growth, it would be ending MRR divided by starting MRR minus 1, or you could simply divide 13 by 100,000. That would give you the same result. Now, let's calculate NRR on the monthly basis. So, it would be starting MRR plus expansion minus contraction and minus churn divided by starting MRR. We would just add brackets to follow the Bodmer's rule here and enter. So we 105% is our NRR monthly. Now let's look at the NRR at the annualized term. A lot of time what happens, investors and FP&A professionals also need to understand what would be the annualized NRR, because we only have the NRR value for the current month. But if we want to convert it into the next 12 months, this is how we will do it. We'll simply take it, and with the power of 12, we are getting our value as 179.6%. So this is the probable NRR that we could achieve at the in the annual terms. Now next we have GRR. So the formula for GRR is starting minus contraction minus churn divided by starting MRR. We would simply add brackets here to complete our formula and enter. So our GRR is 90%, and again analyzing it, given the same rule or same explanation, it comes out to be 28.2%. Now let's understand why NRR is more powerful, or you can say more used, than churn rate. Because NRR captures the full story of the customer retention, whereas churn only shows one side, that is how much customers we are losing. Let's understand this with the help of this table. In this table, I have specified all the metric that we have studied till now and how and what it captures and if it is more investor focused or not. First of all, we have logo churn. As discussed, it only captures customer count. So, can it be greater than 100? No, because it is always between 0 to 100%. It does not tell you about the upsells from the existing customer. And does investors focus it on a lot? Low. The investor focus is very low here. Revenue churn tells you about the dollar revenue you lost. So again, it is between 0 to 100. It does not tell you about the upsells because in churn, we are only talking about the number of customer we are losing. Investor focus is medium here. Next, we have GRR, gross revenue retention. It only talks about the revenue that we have kept in the business with the current customers and the current plans, the current subscriptions they are using. But we are not talking about the expansions. We are not talking about any upsells. It cannot be greater than 100. It does not tells you about the upsells, and the investor focus is high because investor wants to know if there would have been no expansion, how my business would have performed. NRR, net revenue retention. It tells you the full revenue movement. Full revenue movement in terms of expansion, contraction, churn. We want to understand how our business is doing with the existing customer. We can get to know if existing customer have taken up new services or how many existing customers left our current services or downgrades their plan. So, yes, it can be greater than 100%, which you will be able to understand with an Excel example, which we'll be sharing very shortly. And the investor focus on this KPI is very high because, again, it tells the full revenue movement. NRR is one metric that tells investors whether a company has a compounding growth engine or a leaky bucket. Above 100 NRR, the business grow itself. The magic of it is, like, for example, if a company is growing with 120% of NRR, it means that from the existing revenue we are getting 20% revenue increase even with zero new customer. So that is how NRR is helpful in understanding the compounding growth engine of the company. So basically, let's put it in a easy way. NRR tells us even if the company gets no new customer from the market, whether because the market is saturated, we are not able to get more customers for any XYZ reason. NRR tells us how much revenue we will be able to keep growing with our existing customers if we keep on providing them better services or try to retain them with different methodology possible. So, if we have to look at a good NRR story, it could be starting MRR 1 million with expansion 25,000, churn 8,000, and NRR comes as 117%, whereas GRR is only 92%. Why? Because GRR is not taking into consideration 25,000 amount. Whereas if you have to see a struggling NRR story, it could be your starting MRR is 1,000, then your expansion is 5,000, then your churn is 18,000. So your NRR is 87% only. Why? Because your churn is more than your expansion revenue here. So in that scenario, GRR is also 82%. Let's talk about NRR and GRR benchmarks. NRR and GRR are like health report card for a SaaS business. NRR tells us are existing customers spending more or less over time, whereas GRR tells us how much revenue did we retain before considering any upgrades. Let's talk about NRR benchmarks first. If the benchmark is above 130%, it shows that even after losing some customers and facing downgrades, existing customers are buying so many upgrades that revenue grows. If it is between 110 to 130%, it shows that existing customers are expanding their spending faster than revenue is lost. If it is between 100 to 110%, the company is in the minimum viable stage. This is healthy but leaves room for improvement. This means that expansion revenue is just enough to offset churn and downgrades, but not good. Last one is if it is below 100, it shows that the company is losing ground. This means existing customers are generating less revenue than the previous year. Now, let's talk about GRR benchmarks. If it is greater than 90%, it shows that very few customers are leaving or downgrading. If it is between 80 to 90, this shows that some customer leaves but overall retention is still strong. If it is between 70 to 80%, it means that it is not ideal but acceptable depending upon different industries. If it is below 70%, it means that the business needs to bring serious attention towards their customers and their retention. Now, let's talk about monthly revenue churn benchmarks. Revenue churn tells us how much recurring revenue is lost every month. So, lower the better. If it is less than 0.5% per month, it shows that customer rarely leaves or downgrades. If it is between 0.5 to 1%, this means the business is doing good. If it is from 1 to 2% per month, it is in the acceptable range but needs monitoring. If it is from 2 to 3% every month, it means that it is very high and business needs to investigate different parameters of their customers, like what could be the possible reasons for this. Is it poor product experience, high pricing, or better competitors? If it is more than 3%, it means that the company is not able to retain its customer and losing a significant portion of them every year, and if nothing changes, the company could have a major downfall as well. Now, let's talk about three common NRR and churn mistakes. Errors that give a false picture of retention health. First is using revenue in LTV without gross margin. Sometimes what happens if your NRR is 105%, people thinks that wow, we have a good NRR, our company is doing good, but we do not take into consideration the expenses that we are making. So this NRR solely cannot give you a true picture of the business. So we need to pair our NRR with gross margin to get the true or the right context so that we can understand what and how our gross profit retention is doing. Next is mixing new customer into NRI calculation. A lot of time what happens while calculating, FP&A analysts use new customer as well in the NRR formula. But it should not be the case. Why? Because NRR is only there to measure existing cohorts, not the new customer. So, whenever we are working with the NRR calculation, you should always try not to include new logos or new logos related revenue into that. The last one is reporting logo churn when revenue churn is high. A lot of time what happens, companies try to polish the image of themselves. In doing so, they report logo churn instead of revenue churn. They show that out of 100 customers, only 2 have left. But in reality, what is happening, those 2 customers had significant portion of the business. So it is always necessary to report logo churn and revenue churn together, but not logo churn alone, so that we can get a true picture of the business. Now, we have finally ended our video. You can look at the slide for the key takeaways. And next up in the series are CAC and LTV, Rule of 40, Payback Period, Bond Multiple, and many more. So stay tuned with Nerded Off for more videos and content. Thank you.